Late night, they ain't getting no rest. Work so hard, people think I'm obsessed. Cream at the crop, won't settle for no less. Headed to the top, but needed some focus. Yeah, gorilla of the jungle, I've been beating on my chest. I learned from the struggle, it was all just a test.
Hey guys, and welcome back. So today I want to talk a little bit about retail versus the institutional investor. We're going to focus on Berkshire Hathaway. That's Warren Buffett's company. They are one of the most successful investment firms in history. He's also one of the most successful investors. And we've noticed this kind of pattern surrounding major economic downturns where they position themselves very defensively. Usually it's surrounding high market valuations as well as, concerns about volatility, whether it's the macroeconomic side of things. We're going to flip over to our document here. So I wrote this up. We've got Berkshire Hathaway, cash and treasuries positioning versus total assets during major economic downturns. We're also going to take a look at some valuation metrics of the stock market as well as some macroeconomic numbers to really gauge the similarities to prior market periods. And then we're going to take a look at the charts as well and see how Berkshire Hathaway has performed relative to the SPY during these major economic downturns. So the first one that we're looking at here is in Q1 2025, the most recent. So we're going to go from most recent to the oldest, finishing up at the dot-com bubble. That's kind of the most relevant data that we do have available. Some of these numbers are estimates just based on the most available data that we had. So we need to just take it with a little bit of a grain of salt. But that being said, these cash and treasury positions as a percent of total assets really speak for themselves here. So we see $42.2 billion in cash, $305 billion in treasury holdings. They're holding over 5% of the U.S. treasury market, which is a pretty insane amount. Their total cash and treasury amount here at $347.7 billion, total assets of $1.2 trillion. So looking at a total percentage of 29% for cash and treasuries as a percent of the total assets, and of that 29%, it's majoritively in treasury holdings. So that tells me they're positioned more defensively than they are to buy the dip. So we saw a lot of retail investors coming in, buying the dip. We started to also see some hedge funds, big money also coming in, buying the dip. But Berkshire Hathaway remains in their defensive stance. They still believe that this economic context is still very relevant. So post-election volatility, tariff trade war concerns, and high stock market valuations. So that's something that we have talked about. We do recognize a lot of these companies are at some pretty extended valuations, and we kind of need a best case scenario for continuation for another continued macro trend up to the upside. Otherwise, I think we're due for what could be, more downside. It could just be a long drawn out consolidation. That's what we saw in the dot-com era, so we need to pay attention. Let's look here. So in Q1 2025, the stock market dropped about 7%. We saw Berkshire Hathaway outperforming the stock market again, as they typically do when they're positioned this defensively during these times of uncertainty or volatility, especially to the downside. More so than Q4 2022, where they had about 13.4% held here in treasuries as a percent of total assets. And that right there, we had a minus 18% move in the stock market for Q4 2024. Then we had Q1 2020. So this is the one instance where they didn't necessarily outperform the market quite as well as they previously did. You can see here they only had 8% of their total cash reserves in that US, or 8% of the total assets in US treasuries. That tells me basically they weren't prepared for this crash, but neither was really anyone. So it would have been really hard to really move around substantial amounts of stocks without kind of drastically affecting the market. When you're holding $788 billion in assets, if you start dumping all your stocks, you're going to move the market. So we saw here, I don't think they really anticipated this crash. As I said, I don't think a lot of people anticipated it. It would have been very hard. So we see here their cash increased from $30 billion in Q4 2019. He sold airline stocks, maintained liquidity within those T-bills, but it wasn't quite as defensive as what we saw in 2022 or 2025. So interesting to note there, kind of pointing out that you can do all of the all of the due diligence, all of the analysis. You can be one of the most successful, most experienced investors, and you're still never going to get it right 100% of the time. So just because they did really well to position themselves defensively in other instances doesn't mean that it happened 100% of the time. Q1 2020, I think, was that instance, kind of a bit of an example where they didn't really outperform like they did prior. And then we see here Q4 2008 up near that 13.3% as a percent of their total assets in treasuries. So that's more similar to what we saw in 2022, and it's way less than what we're seeing right now. So interesting to note that. And we saw the stock market performing very poorly in Q4 2008, minus 37%, while Berkshire Hathaway was able to outperform. So that's kind of what we see, is this company has consistently outperformed the S&P over a very long period of time. So not many people and not many firms are able to say that they've done that, and done it with the success that Berkshire Hathaway has. So when we pay attention to these big investors, I think it's worth paying attention to this company, seeing how they navigate the markets. They kind of approach with a similar strategy to myself, although obviously I take a lot more risks individually because it's just a different strategy. But at the end of the day is they're not trying to time the top and they're not trying to time the bottom. They want to make sure that they're getting in at value, like valuations that are very attractive. So they position, when valuations are high, they start trimming their risky positions, adding to that cash position. They wait for the reset, they put that money back into the market, and then they ride that back to the upside. So that's similar to what we do when we trend trade. We're not looking to time the top or bottom perfectly. We're looking to get in that early trend reversal when things are low, they're cheap, and they're starting to reverse to the upside. And then we're mitigating our risk, taking profits when things get a little overheated, start to show us those warning signs before we experience any major downside. That lets us realize these returns, put it into cash. We do a similar thing here. So rather than using short-term US Treasury bills, I use a high interest savings ETF, which pays about 4% per year. So I have this risk-free investment capital, essentially this risk-free interest coming in every month. As I continue taking profits on my riskier positions during high valuation periods, I'm just taking that cash. I'm not in a rush to put that back into the market right away unless I see a really good opportunity. So it's all about taking advantage of opportunities both to the upside and the downside. We don't want to round trip our gains, and we don't want to buy falling knives. So that's why I've developed this system, and I haven't even developed it myself. It's essentially a ton of different tools, strategies, data that we can look at to help remove that emotion. So all this stuff I've learned kind of just self-directed through various resources. There's tons of books, tons of online resources, lots of people you can look to learn these things. I always emphasize really learn the tools, learn the skills. Don't prioritize copy trading anyone. You're never going to have conviction in your investments if you're copy trading or you're looking for someone to tell you when to buy or sell. Even me, I make mistakes. I might be watching something and then sometimes, I take off for the day and I'm not able to act on it. Things come to my levels. I miss opportunities despite the fact that we've identified them previously. It's part of the game, but I never kick myself because as long as I'm consistently profitable within my current portfolio, I don't care if I missed out on something. There's always going to be another opportunity, and we need to be able to take advantage of those opportunities by chasing things when valuations are high. We run higher risks of buying the top, getting into that downtrend. We don't have the same buying power we would at the lower valuations, and we aren't really following that strategy of not buying into resistance when things are crazy and overheated. That's what I say. Patience, patience, patience. That's going to be the biggest thing as a retail investor. This is a long-term game. This is not something that's going to play out over a year or two and you're going to have, you're going to be a multi-millionaire, you're going to be out of the game, you're just going to win, 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 and then you're going to be retired. It's not that easy. You're going to make lots of mistakes. You need to figure out ways to mitigate the chance of making those same mistakes in the future. That's what I'm trying to teach you. That's what I want to emphasize. and that's what I try to do within my own portfolio. So you're always learning, you're always evolving as an investor, as an analyst, or whatever you're into. So we can scroll down. I got a little bit off topic there, but we see Q4 2002. We also had a minus 6% correction here in the SPY. Berkshire Hathaway doing pretty well here. They were positioned 9.4%. So also similar, lower cash, similar to what we saw in kind of 2020. Q4 2000 though, dropping 7.8% in the stock market. They were more defensively positioned here at 14%. So Q4 2000, that was high liquidity to avoid tech bubble, estimates based on his conservative approach. So again, he's citing the overvaluation of certain assets around this period. And we also notice the defensive positioning was similar to 2008, moderate cash opportunity investments, but we also see here T-bill estimate was based on liquidity preference, but essentially we saw in 2008 positioned similarly to 2000 here. So they've done a really good job of defensively positioning themselves, but it is a little bit worrisome to see them at such a high amount of cash here. They're well over 2 times what they typically are during these major economic downturns. So we need to pay attention to that. What we see here, current positioning, just kind of a recap, 29% cash to assets ratio dwarfs the prior downturns, signals extreme caution. His T-bill focus is generating significant income, and that tells me they're positioning more for a market correction than they are for acquisitions. If they start unloading their T-bills and start rebuilding that liquid cash position, they might be looking to put that money back into the market. But for now, it looks like a more defensive play. We can see here Berkshire Hathaway stock performance versus the S&P 500 surrounding these major economic instances. 2025, BRK had a 16% gain versus the S&P's 4.5% loss. So really outperforming the S&P here in that Q1 2025. 2022, 3% gain for Berkshire Hathaway versus the S&P 500's 18% loss. Again, outperforming it by almost 20%. Here we see 2020, this is where they weren't able to avoid that downturn. They got caught in it, but their drop was less severe than many peers because of their diversified operations, because he always maintains kind of a similar strategy. You know, you're never always fully allocated into the market. You're always kind of strategically buying and selling positions, maintaining that cash position so that you can take advantage of the opportunities as they come. So we see here, they still outperformed the market despite getting caught in that drop nonetheless. 2008 outperformed the S&P slightly, but still fell alongside the markets. In 2000 and 2002, they also outperformed while the markets fell due to their value-driven strategy. So in Q4 2002, we saw their shares rising 4.5%, and in Q4 2000, we saw their shares gaining 7.2%, and that was during this 6 and 7.8% drop in the SPY. So you can see, basically, on average, surrounding these major economic downturns, Berkshire Hathaway has outperformed the stock market by about 15 to 20% pretty consistently. So other things to note about this, the T-bill estimates for 2000, 2002, and 2008 kind of rely on his known liquidity preference. Exact data is limited, but it is pretty obvious the major increase in that percentage of treasury bills. 2025 total assets are also projected, so we could get some differing reports here. And we also see economic drivers can vary here. So 2020's rapid recovery versus 2008's prolonged downturn. Also, I would also draw a reference to 2000 to 2002. After the dot-com, we had a very long, slow consolidation. You know, the market just kind of chopped sideways for a while before we actually went on that new trend to the upside. What we see here, macroeconomic indicators across these economic downturns. So Q2 2025, we saw real GDP growth come down. ISM here under 50, so not ideal. Very similar to 2022. What we saw also kind of similar to Q4 2000. GDP is worse here than Q4 2022 and worse than Q4 2002 and Q4 2000. But it is doing better than the 2008 2008 financial crisis or the COVID crash here. So holding a little bit better in terms of some, but a little bit worse than some other economic downturns, which tells me, you know, we might be looking at more of a comparison to 2022 and 2002. So we'll continue keeping that in the back of our minds. We've got consumer sentiment here, similar, a kind of lower reading. These are also trending down. It's not the best look for markets right now. Consumer sentiment also lower than Q4 2022, Q1 2020. It is lower than Q4 2008, much lower than Q4 2002, and a substantially lower than Q4 2000. So consumer sentiment is worse than any of the prior major economic downturns. Consumer spending here is actually holding up pretty well, much better than Q4 2022. Not as stronger than Q4 2008 by a long shot, stronger than Q1 2022 by a long shot. Kind of similar here to Q4 2002 and Q4 2000 because we've got 1.7% and 2.5%. So kind of similar to there. Inflation, we're looking at 3.5%, kind of a little bit lower than Q4 2022. The Fed's done a pretty good job of combating inflation, so we hope to continue seeing that. But look at that, 3.5% inflation. That's also basically what we saw during the dot-com era. So another very similar economic number there. Unemployment rate, we're at 4.2%. We're actually higher than the Q4 2022 unemployment rate. We're much lower than Q1 2020 because COVID just shut the world down, and we're lower than Q4 2008. So we're actually above Q4 2000. You see here from Q4 2000 to Q4 2002, the unemployment rate continued to rise. So that's something we could watch. Look for that comparison. We do see that the unemployment, though, remains elevated. Inflation remains similar to Q4 2000, so lots of similarities here. And last thing we're looking at, we've got our 10-year and 2-year Treasury yield spread, and we've got our 10-year and 3-month Treasury yield spread. So currently looking at minus 30 here for Q2 2025, minus 50 for that 10-year and 3-month. A little bit, not quite as bad as 2022. Q1 we are actually positive here, and that was kind of that surprise drop. Q4 2008 very positive, and we also see Q4 2002 very positive. Q4 2000 a little bit less there. So we kind of see, you know, we aren't quite at that worrying level yet, and kind of that similarity to Q4 2000 as we get to these more elevated targets like in 2008 as well as in Q4 2022. That could be indicative of more of that kind of slower, drawn-out correction. It's not going to be V-shaped. We're not printing $12 trillion of money this time. It's not going to be like COVID. So I don't really buy into the narrative that kind of trying to really draw major comparisons to last cycle, when the fact of the matter is we're not going to print $12 trillion again. We're not going to give thousands and thousands and thousands of dollars to everyone who applies for it in the form of stimulus checks. That's just a little bit unrealistic to expect that, in my opinion. Going down, we are going to take a look at the S&P 500 PE ratio, the CAPE ratio, the market cap divided by GDP. We've got our CCI here. We've got our that's our Consumer Confidence Index. We've got our Buffett indicator. That's that market cap divided by GDP, federal funds rate, and leading economic index. And then we're again draw those comparisons. So S&P 500 PE ratio currently at 24, more than Q4 2022, more than COVID, more than Q4 2022, more than 2002, more than 2008. We're just below Q4 2000. So Q4 2000 is the only one, that first dot-com drop, where we've had a higher reading in terms of PE ratio on the stock market. Taking a look at the S&P CAPE ratio, so the Shiller price, the Shiller PE here, we've got 38 for the current quarter. We're looking at more than 2022, more than COVID, more than 2008, more than 2002. Again, the only one that dwarfs it right now is Q4, that .com. And same thing here, the Buffett indicator. This is the highest reading that we've ever had, 200% more so than the 190% that we had in Q4 2000. So we're looking, and all of these numbers, the closest comparison we're finding is that 2000 dot-com move. So another thing we need to be aware of, again, valuations are high. I don't think everything just runs up forever. We don't get these crazy V-shaped recoveries without retesting support unless we're getting a substantial amount of liquidity injected into the system to support that, which isn't really the case right now. So continuing on, federal funds rate, similar here to 2022, different environment to Q1 because of COVID, very low interest rate environment, kind of more similar to 2022 and lower here than Q4. So kind of, again, interest rates a little bit tighter here in Q4 2000. Liquidity might have been a little bit tighter as well. So we might see a little bit faster of a recovery for if it kind of plays out within that same analog as Q4 2000, we could see the recovery come a little bit faster because the restraints on liquidity aren't quite as high, but that's something we'll have to continue following. Looking here at the leading economic index, so we see minus 2.5% here, minus 6% in 2022, minus 6.7% in 2020, minus 12% in 2008, plus 2% in 2002, and minus 0.5% in Q4. So basically, again, nothing really overly worrying. It's not quite as bad as Q4 or Q1, but it's also, pretty close to Q4 2000. So just because this is not quite as bad as COVID or 2022 doesn't mean that we can't experience downsides. So it's just another number to look at, to draw comparisons. The more data we can analyze, the more information we have, the more knowledgeable we are as investors. So here, last but not least, Consumer Confidence Index, we're at 86, so quite a bit higher than Q4 2022, a little bit lower than COVID, a lot higher than Q4 2008, but we're kind of similar here to Q4 and Q4 2002 and Q4 2000. So very similar. The closest conclusion I can find based on all of the numbers relative to each other, we're looking at a potential similarity to Q4 2000, which also led into 2002. This was a long downwards / sideways consolidation in the market for multiple years. That's also something that a lot of analysts have been potentially projecting, is kind of stifled returns in the stock market over the coming years because we had such explosive, consistent growth to the upside. So we'll have to continue following that. At the end of the day, the charts tell us everything we need to know. But our conclusion, economic signals, Q2 2025 shows mild economic contraction, GDP growth negative, manufacturing activity is slowing down, low consumer sentiment, inflation is moderate, not too bad, unemployment slightly elevated, inverted yield curves. So we do have those signals that are potentially recessionary risks. We've also got market valuations, high valuations persisting across there. We talked about that, indicating that overvaluation and vulnerability to corrections. We see Berkshire Hathaway's position, record amounts of treasuries, 29% of total assets, reflecting extreme caution. We see they've outperformed the stock market during this correction because of its safe haven status, consistent with that historical outperformance during prior downturns. So the market and the economy in Q2 2025 exhibiting recessionary signals with high valuations and Berkshire's unprecedented cash position, suggesting Buffett anticipates volatility or opportunities to buy things cheaper. A market correction is the most likely outcome. We've already had a 22% correction in the stock market, so that could be it, but we're not sure. We don't have confirmation on the charts yet. We haven't broken out over that kind of key resistance in the SPY. We want to see continuation on the higher time frame, higher weekly lows, so we can continue and get a hopeful next leg up. Otherwise, we could always break back to those lows, potentially lose them, and continue lower. That's always an outcome. Especially as a chartist, we have to remember that is a potential. And given historical parallels and indicators, we're looking at similarities to those prior economic downturns. So we should kind of be ready for volatility, consider how we can take defensive strategies with our positions. We talked about stop losses in 2 prior videos in the past week. I talked about both how I utilize multi-time frame setups, how I put my stop losses, where I'm putting my personal stop losses on positions, because I really want to show you guys how I kind of act defensively but maintain that market exposure. So I'm not taking stuff off the table right now. We previously sold near the all-time highs in the stock market. We redeployed our cash on that substantial market correction, and now we've got some more positions sitting nicely in profit, and we've got those stop losses trailing to the upside. So we've pretty much protected those gains, protected those positions. We kind of maintained that exposure to the market. We've been able to opportunistically add to our cash position. That's kind of really kind of helping that defensive side of things, but we aren't too sure which way things are ultimately going to go, if they're going to break up or down. It's impossible to tell. So we just need to prepare our portfolios for every outcome. That's what I'm trying to teach you guys. That's why I follow the strategy that I do, and I'll continue following it, continue breaking it down, how I approach this market. But we're going to flip over here. This is a nice little graphic here to kind of compare institutional versus retail inflow. So this is since December 2024 and January 2025. You know, the most recent data is going to be a little bit updated here. So we have seen some money flowing back in from hedge funds, but ultimately what we saw here, private clients, so that's like retail investors, really increased their amount of buying here, while hedge funds and institutional clients were selling. So basically up until the end of 2025, a lot of big money was selling while retail was buying. That kind of, the last time we saw that was back here in kind of 2021, 2022, where we saw major selling and buying from retail. That was before the 2022 bear market. So interesting to note, we kind of have seen retail kind of stepping in, buying the dip, while hedge funds have actually been selling over the last few months. So another thing we're going to jump to here is this kind of breakdown, retail investors buying the dip. This is just different data from different analysts. We see JP Morgan says here retail investors bought 4.7 billion in stocks on April 3rd, highest single day inflow in a decade. We saw Vanda Research says here they saw US retail flows into stocks surge in early April. Bank of America says the same thing, 21 consecutive weeks of retail inflows, longest streak since 2008. Investing.com, retail has poured 32.9 billion into stocks since late February 2025. CNBC saying here that during the April dips, lots of investors getting back in, seeing it as an opportunity, billions falling into those funds. And then we see institution and hedge funds selling. Goldman Sachs hedge funds sold the largest volume of single stocks in a week since 2010, following Trump's April 2nd Liberation Day tariff speech. So we followed that. We sold, we took that profits, mitigated our risk, avoided the downside. So really good job there. We did see though, they slashed that equity exposure by 45 billion over 30 days. Has noticed here, hedge funds sold consumer discretionary stocks heavily, anticipating that downturn due to tariff-driven bond market disruptions and spiking junk bond spreads. So again, we're kind of seeing a little bit of a disconnect here. You know, early in the year, a lot of big money selling while retail was buying. Currently, though, we see that retail investors bought the dip and hedge funds sold. It's well supported through the data from these various analysts, but we do see that retail inflows hit record highs. Hedge funds selling, though, into the retail. So we need to continue following this. We want to watch these, this big money, this smart money, come back into the market, start buying into stocks, but they're not going to do it when things are at really high valuations, and the charts haven't really confirmed anything on the high time frame. So last thing I want to look at here is Berkshire Hathaway and their performance relative to these major economic downturns. So I've marked all the different instances here. We've got 6 since 2000 where we have had kind of these major economic downturns, and we're going to take a look and see what we can kind of gauge from each one. So we saw in this here, we basically, while the stock market was trending up, we saw Berkshire Hathaway trending down. That might have been because they pre-positioned themselves a little bit early, but right here, as the stock market tops and starts trending down, we saw Berkshire Hathaway breaking out. This right here is just the quarter that I marked in that economic downturn. So we see here, right within that quarter, that's when Berkshire Hathaway starts outperforming. And then all through 2000, 2001, 2002, 2003, they basically outperformed the S&P. So during this whole major economic downturn, once it did materialize, they broke out and kind of maintained that outperformance. We can flip over here to 2008. Same thing, we see them outperforming during the whole crash here. So less downside risk and more outperformance to the upside. Flipping over to the next instance we saw in 2020. This is one where they weren't able to really mitigate that risk. So tracking the S&P pretty close, and yeah, it was able to hold a little bit higher. Like I said, they performed a little bit better than some of their peers, and then ultimately though, it took a while for them to really catch up and break out and start outperforming, which again happened when we got to those high stock market valuations around 2022. Downtrend begins in the SPY, and Berkshire Hathaway breaks out outperforming, and again continues that outperformance into this quarter here. And last but not least, they maintained their outperformance all the way to the stock market highs, and we see stock market crashes, Berkshire Hathaway positioned for that crash. They're pumping, they're holding up here, looking really good. So that's kind of just what I wanted to talk about. We have to consider the possibility that something like 2000 could play out again, where we get a longer, kind of more substantial downtrend or sideways consolidation. But until we kind of get that confirmation on the chart, so let's flip to the SPY quickly and take a look at our candlesticks. I'm going to get rid of this comparison. So let's pull up. We're going to take a look at the various indicators here. And see what we're looking at. Take our parabolic SAR. We see so pretty much right now we've got the higher low, higher high. We need to continue holding these higher lows. So it's looking decent from a technical perspective. We could continue up. Look at this big volume here and follow through. That's what we want to see. We see the parabolic SAR flipping up on the weekly here. So what we're going to look for is the potential re-entry positions. If we come back to under 540, down to about 505 for the SPY, that's going to be a decent opportunity to potentially take a swing position, stop loss under support, and hopefully we get that continuation leg to the upside. That being said, yields are still elevated. The dollar is showing some weakness. Gold is back up. Silver's back up. So we see the Swiss franc and the Japanese yen also up. So kind of, again, we're not really getting that clarity when it comes to risk on versus risk off. There's a major disconnect between the stock and the bond market. Until we get that technical confirmation on the high time frame here on the SPY, I'm not interested in taking additional risk. So if we find nice technical setups in individual stocks, we can explore those as we see fit. But in terms of the SPY right now, again, my thoughts are always that things never go straight up. We're likely to come back, retest prior resistance, flip it to support before we can continue on that next leg up. So for now, we're too extended, we're close to resistance, not worth the risk. We've got positions, we made some buys, we have exposure, we're just riding that to the upside, continuing to trail those stop losses up. We'll take them wherever it kind of leads us. Continue moving those stop losses up as we get taken out, or those profits are secured. We can really start to kind of look at how we're going to reinvest that capital back into the market in that kind of liquidity cycle where we really want to take the profits, realize them, put them back in, same thing, rinse and repeat, compound those gains, and that's how we're going to be successful in the long term. So thanks so much for watching, guys. I know it's a bit of a long one. There's a lot of data to cover in this one, and I wanted to be very thorough and kind of cover a lot of different metrics, look at both Berkshire Hathaway as a company, as well as the macroeconomic numbers and the valuations of the stock market, really get a good idea of what's going on. That's what I think we need to do as retail investors, give ourselves the most possibility for success by being knowledgeable of what's going on in the markets and what's happened in the past as well. So thanks so much, guys, and I'll see you in the next one.